when private loans go bad and bailing them out. Lessons from managing 150 million in a downturn with Kyle Ford. But before we get to that, welcome to the Truth About Real Estate Investing Show. Thank you to all the kind listeners who leave 5-star reviews on any platform, and shout out to all those listening on Spotify and leaving 5-star reviews. I'm just returning from a retreat with my mastermind group in Entrepreneurs Organization Conference in the lovely Victoria, BC, where I met several successful big-time entrepreneurs, including real estate investors. Some of them do mid-sized development projects, like, for example, starting with a fourplex, and then they tear off the roof and they add 2 more units on top, and they dig and underpin the basement to add 2 more units to the basement. So they took what was a fourplex and made it an 8-plex. So basically, they're going to double the rent. They're probably going to do more than that, though. Another developer owned hundreds of acres in the Niagara region, and then they've since sold it off in pieces to builders. Another builder I met, he happens to be from Mexico. He builds and develops in both Mexico and in Vancouver. He does mid-size use, large, not large, but a mid-size residential with commercial on the ground level, and he assembles land. And for example, he shared how he bought a couple houses next to each other in Vancouver, which he's going to develop. Another investor I met flipped hotels way back when. He bought them distressed from a bank during a recession, paying very little, pennies on the dollar, and then he later turned them around and sold them off. And these were big brand hotels. The end product was a big brand hotel that you've likely heard of before, likely stayed in before. One thing I really enjoy about being part of these events and Entrepreneurs Organization is connecting with entrepreneurs and investors. And what's great about them is how honest they are. We actually have to go through extensive training to belong to this group, which involves being vulnerable and speaking from experience. We don't small talk much. Instead, we go deep pretty quick. And because we all have many things in common, we cut most of the bullshit. And again, we go straight to the truth pretty often, pretty quickly, which is what I enjoy. I enjoy learning, and I enjoy hearing the truth. Also, there's no solicitation rule within the network. Folks can do business together, but one party to a conversation must invite the other person to pitch. There is no unsolicited pitching. Also, my members must meet a certain financial milestones, and they have to be signed off by one's accountant. So again, everyone at least has achieved a certain level of success to be part of the membership. It's not like those weekends, I've been to like those weekend real estate whatevers, and just the last one I was asked by a complete stranger if I was interested in investing in their development project, their second ever development project. Anyways, Damien, who's originally from Mexico, he's the Mexico and Vancouver developer, asked Damien if he would be a guest on this podcast. Naturally, he asked, "What podcast?" He's obviously not one of our 17 listeners, like the vast majority of Canadians. So I told him it's called the Truth About Real Estate Investing Show for Canadians. Damien then proceeds, he whips out his phone and he asks, "Oh, are you on Spotify?" And so, yeah, we're on all major platforms. And then I told him the name of the show, he typed in the search. And to my pleasant surprise, our rating on Spotify is 4.9, 4.9 out of 5, with 49 reviews. So there's not nearly as many reviews compared to Apple Podcasts, but the rating is higher. So all of a sudden, I'm feeling very confident in Damien is honored to be a future guest of the show. So yeah, for all you listeners, I know we do have a lot of Ontario guests, I know, and but sit tight. We do have some folks coming from the West Coast shortly. So thank you to all who've left a 5-star review on either Apple Podcasts or on Spotify or wherever other platform this is on. It does help me book excellent guests of the show. The more listeners we have, the more 5-star reviews we have. Again, that helps me attract high quality, talented people. So, and by having better guests on the show, that helps us improve. That we all improve as a collective, and learning from world-class investors. We will learn from their mistakes, their best practices, and what makes them tick. So that you may take it away. You may leverage the experience of others in order to bring you better success in your own business. And because who knows what the recession will bring. From talking to big time ballers Again, and on the real estate side, I met several people who have made well over 10 million in real estate. So like again, they've made over 10 million, right? They don't own 10 million. They made over 10 million. They got their eyes open for opportunities. No one really knows where things are going, but everyone's got these guys who've done quite well for themselves. They got their eyes open, and those who are leveraged, well, those folks are not having any sort of fun. But that's just real estate stuffs. There were other successful people outside of real estate investing, but before I get there, there should be no surprise. There's a lot of successful real estate entrepreneurs out there. That should come as no surprise. But this wasn't an entrepreneurs conference, so there are many other experts speaking, including the owner of 1-800-GOT-JUNK. I'm sure many of you have seen their trucks going around. I believe they are the largest junk removal company, at least in North America, maybe the world. They do over $700 million in U.S. revenues, $700 million U.S. in revenues a year. So he had some stories and lessons to share. I actually had to sign an NDA for that before that speech was given. Also, we had the founder of Hootsuite sharing his story and what he's doing with his venture capital fund. He's writing checks. He's writing $100,000 checks and mentoring young Canadian tech entrepreneurs. So very fascinating stuff. There's many ways to make money, both morally and ethically well. Yeah. And again, also there was this mind-blowing expert. My mind was mostly blown by the AI expert. This gentleman went viral as he was able to hack into his own bank account in 5 minutes using an AI tool to fake his own voice to beat the voice recognition protocol on his bank account. The CEO, the CEO of the bank, called Nicholas. The speaker's name is Nicholas. The CEO of that bank called him shortly after, asking for advice. I'll be inviting Nicholas onto the show, and may mention that we have many wonderful listeners who've given this show a 5-star review. AI in the real estate context, however, Nicholas had shared how he designed and delivered a website. A very, very impressive website for real estate developers' purposes. So it's a gorgeous looking building. I think he might have said it was like a custom home builder. But anyways, the content, so everything that went on the page, he said it took him about 15 minutes to create using a number of AI tools. So he shared that this business model will dominate going forward. Who can create a replicatable business model using AI to save time and money? The analogy he used is there is no Staples easy button. A human being will still need to put it all together and assemble it and review it for accuracy and quality. And whoever is successful at this model will put the slower, more expensive companies out of business. So you better believe me, I'm looking into all areas of our business, including property management, on how to better implement AI. And I'll do some later in this show, actually. Personally, I'm always afraid of the future, which leads me to research and take action. Real estate investing makes a ton of sense to build wealth. It's less difficult to do than most ventures, and it's honestly the right solution for most Canadians most of the time, if done correctly. Speaking of being afraid of the future, I'm always worried about my kids. I am a hyper overprotective parent. In particular, and them being bullied. From my experience, being bullied was not enjoyable at all. It really hurt my confidence growing up and self-esteem, and I wouldn't wish it upon anyone. Hence, I'm hacking my kids' self-defense by having them train the most efficient self-defense martial art, which is Brazilian Jiu-Jitsu. My kids got, just last week, were finally promoted from white belt to gray/white belt. I don't know the belt system, but anyways, they got promoted. The delays were caused by the pandemic, and yeah, that wasn't any fun. And I honestly couldn't be more proud. My son being only 7, he shares almost everything to his classmates. He really has no filter. He happily shares the story of that time I tore the back of my shorts while trying to do what's called a bum drop on a trampoline in front of my kids and my family friends. Thankfully, I was wearing underwear. My son even shared to the class bully. The class bully happens to take karate, and my son, he takes Brazilian Jiu-Jitsu. The bully's response? He has no interest in messing with my son. Mission accomplished. Proud dad moment Check. Speaking of mission accomplished, the Bank of Canada raised rates again by 0.25% to further slow the economy and the real estate market. Just like they were slow to respond to all of the government pandemic money flooding into the economy, inflation rates were well over 4% in 2021. The Bank of Canada looks to be overshooting on rates now, as we're now at an overnight rate of 4.75%, while inflation over the last 2 months were about 4.3 and 4.4. So yeah, we'll see where things go. My prediction is inflation rates slow. So again, who knows what the Bank of Canada is going to do? But to me, it is what it is. I can't control what the government does. I just read and react. The way I see things is the housing market's recovery. It's been too fast, in my opinion. After the downturn went pretty quickly in terms of how aggressively it fell. And in my opinion, the recovery has been very aggressive and fast. And some of my rich friends out there, they're having trouble getting their offers accepted in Toronto, and they're offering hundreds of thousands of dollars over asking. But yeah, these elevated rates should slow the recovery as financing gets more expensive, which means more tenants for us existing landlords. Not that we need that much more help, considering the hundreds of thousands of international students coming each year. If you bought smart in a college or university town, like we always, just like our clients always do, you're laughing. Speaking of buying smart, normally I would be promoting one of our iWin Mastermind tours in Hamilton, which is coming up June 24th, but it's already sold out. So stay tuned for next time. Our next event is online, virtual and online, via Zoom. The iWin meeting is Tuesday, June 25th at 7:30 p.m., where we will be sharing the highest and best use real estate investments for the beginner investor / developer to maximize returns while helping society at the same time. Yes, you can make a great return and do good for the society, which includes creating more homes and density. Now, onto this week's show. You know about the downturn we just experienced, and like many of you, I was curious how the private mortgage companies fared. So I reached out to Kyle Ford, whose company manages $150 million in private mortgages. That's right, 150 million assets under management that they lend out for alternative use. They're not like a bank. They're not like the Bay Street banks. They are small. 150 million is small compared to the big banks. It's not small to me, though. Kyle tells it like it is. He shares how many mortgages went sideways during the downturn, what the lessons were, how Kyle and his staff put up time and money into taking over failed BRRRR projects and flips, major renovation projects, to finish projects and sell them off in order to make his clients whole. Why? Because it's the right thing to do. Treat other people's money better than you treat your own. If you won't invest your own money into your project and you can't pay people back when deals go bad, then don't use other people's money. If you don't believe me, ask bankrupt investors how they, we've had bankrupt investors on this show. Ask them how much other people hate their guts, people's money who they lost, and they can't pay them back. So instead of using other people, use debt. My clients and I all use generally largely first mortgages and home equity lines. It's cheap, and you don't have to give up control of the project. You don't have to give up any equity in the project, and it should be everyone's first option. If those things were never available to you, I think you need to question. Not need to question. I think your priority is go make more money in your day job first. Back to Kyle's interview. We journey back to when he was an alternative financing borrower, because Kyle was taking courses, he's doing value-add projects, so he was doing major renovations, renting them out, and then getting new mortgages. So he needed short-term money to do those sorts of projects. And then came 2017 when the mortgage stress test happened, and Kyle had limited financing options, but he needed short-term mortgage money, in order to continue funding his value-add real estate investment strategy and business. As the saying goes, necessity is the mother of all invention. Kyle found other sources of private capital. Then he started brokering his own deals, He comes from a financial planner background as well. Yada, yada, yada. I'll let Kyle explain. But he now manages a fund. How's that for yada, yada? Going from a duplex, triplex investor to managing $150 million fund. And Kyle admits, just like we do on the show, it's never all sunshine and rainbows. As mentioned, some borrowers of his went sideways, and Kyle shares how those deals went, postscript, and what happened when he had to take them over, and also his lessons from the downturn. Kyle also has a contrarian opinion of promissory notes as well, so you do not want to miss this episode about the truth about being a private lender. Now, as we are covering a securitized investment, here comes the disclaimer. And I mentioned I'm looking for you how to use AI more and more, so I used AI to write the disclaimer that's coming up, and a separate AI tool to voice the disclaimer, and it did it all for free. So this also saves you all from having to hear me stumble and mumble. To reach out to Kyle and Company, website is capgapmft.com. Again, that's capgapmft.com. And his email is info@KyleForwardMortgages.com. All of it's in the show notes. Please enjoy the show. Hi, Kyle. What's keeping you busy these days?
Hey, everyone. Doing well. Keeping busy with real estate, the mortgage business, the new private mortgage fund, and everything else. Family, friends, all that good stuff as well. So.
I imagine you're pretty busy. Like, you have a good number of clients and a sizable team, and you're just starting a new fund, which is probably a lot of money in it.
Yeah. We it's double-digit number of corporations that I'm managing and operating right now. It's all real estate based, but I feel like I'm pulled in a few directions. One of my goals in the new year is I'm trying to get a little bit more focused. Trying not to. As you grow your real estate portfolio, some people, including myself, can be guilty of the shiny object syndrome, and I've had that a little bit over the years, pursuing different types of investments, but really trying to get focused now.
That's actually an interesting point, because like, you're at a scale that you're quite large, and you push your weight around, including like pretty large scale developments too. How are you choosing to focus then going forward? Because you have lots of opportunity to look at, do you not?
Yeah. So, the personal stress is a big part of my new pro forma. What is this deal? What is my responsibility in the deal? What is my partner's responsibility in the deal? How much investor capital do we have in the deal? And what's the ultimate stress level that's going to be put on the personal and the partnership in order to execute it? And that's a big factor that isn't a normal line in a lot of people's performance, but something that I take very seriously now. So we've done everything from small singles, triplexes, large development. We're definitely more focused on development deals, larger multifamily, and private lending. So those are kind of the three tiers. We are in the hospitality space with cottages and a hotel, and we're going to keep running with the hotel, but the cottage business has been great to us. I love it. We've had over a dozen at our peak, but we're definitely trying to lower that a little bit. Just a handful of a couple of nice cottages that we like, but not really trying to grow that business anymore.
So, Kyle, when someone asks you to tell them about your business, so for example, apartment building investors, real estate investors, they often talk about how many doors or how many properties they have. What do you tell people?
So a couple things. So first of all, I don't talk indoors. I talk in AUM, assets under management.
Yeah,
so
I
that's
like it.
Between my private lending portfolio, the properties that I own, the properties I invest in. In terms of AUM, I'm well above 150 million in terms of assets under management. So that's really the language that I use. I stopped chasing doors a long time ago. I'm more when I do a deal, I'm more concerned about the lift. How much? What am I buying it for? What am I spending on it? And what's it worth when I'm done? I'm blessed to have a successful business that generates me lots of income. So I don't need the cash flow from my properties to support my lifestyle. I'm not saying I don't buy cash flow properties, because that's still important, but I don't actually need that money coming off the properties to support my lifestyle.
Right. So then what do you do with the money within the properties?
Reinvest. So continually reinvest when the cash flow is coming in on those properties, reinvesting in buying more, larger deals, those type of things.
Right, right.
Right now, one of the things that I'm doing in my portfolio when I talk about getting focused is I'm selling a lot of the small stuff to allocate more towards my fund, which is private lending. So looking to get a little bit more passive. I've been on the grind for 10 plus years. So it's nice to try to direct a little bit of cash towards some passive investments.
We'll get to the fun in just a moment, but I want to say thank you for sharing that is your investment strategy in the apartment building space, because it always concerns me. I see a lot of marketing out there around like apartment building, multifamily, about being a means to retire. Like, to me, that means you still need cash flow to retire, but you're saying you're reinvesting it all.
Yeah.
Versus like I fear for the novice that gets into it, because the novice will often overpay, because that's just the position they're in. They don't have those relationships to get a deal to come to them, and then the cash flow would not be sufficient for them if they quit their job.
Yeah, I see it all the time, and if we use that novice example of they're trying to find a money partner and they're going to be like, the property's going to cash flow X amount every month. Mm-hmm. Yeah, but can we really take that out of the account? Like, can we really leave? I know we have a repair and maintenance budget. I know we have vacancy budgeted and all those things. But can we really take that couple $1,000s a month out of the account and spend it? And in a lot of the deals that I'm looking at and I'm analyzing, the answer is no. That money needs to stay in that account unless both partners are prepared for cash calls later. But if we're taking the money out to put it back in later, what's the point, right?
Yeah. And then you see deals from your mortgage business and from your own, whatever crosses your desk for your own portfolio, right?
That's right.
So you see a lot.
Yeah, deal flow is not an issue.
Right. Because your clients are bringing you deals as well to evaluate for them for financing purposes, right?
That's right. And oftentimes asking if I know anyone who wants to put partners who are interested. And we don't broker partnerships. We broker private money, but people are often looking for partners, run the deal by. They're coming to me saying, how is this going to be financed so I can project a pro forma to a partner? Those type of questions.
So let's talk about, say someone brings you a deal and needs money. You said that you broker private money. What if they need a first mortgage on an apartment building? That's not.
Oh, yeah, of course. So we're a full service mortgage team, mortgage brokerage. So we deal with the big banks, the big lenders, alternative credit unions, mix, the entire spectrum of lenders.
Right.
We deal with in other privates, so institutional privates like mix. We also have our own private money. We have our own fund money. So it's based on what the client needs, what the best interest of the client. We can run them through the spectrum. What we're seeing a lot now, and I've been seeing this for a while, is a lot of the purchases aren't being done with the A-rate lenders. They're being done with an alternative lender to get in, help stabilize the property,
right.
And then once the rents have been stabilized, utilities passed on, fixed up, etc., then the property's more stabilized to go to a CMHC type lender, to go to a big bank, a credit union, etc.
Interesting. What's like the baseline for someone to go alternative versus a lender? Like, at what point? Like, because I'm a novice to this area.
Yeah. Well, so the biggest thing, the biggest thing that I see is, especially in today's environment with the higher interest rates, when they're running an NOI calculation, the amount of down payment required to go straight to a big bank right away on a multifamily type deal is pretty large. So and this is also going to go back to kind of the profile of who this person is and what they're buying. If you're buying a relatively turnkey apartment building, so maybe it's not like top market rents in a beautiful condition, but the rents are decent, the income and expenses are okay, and you're buying it on market, you're probably looking at a 30-40% down payment just based on where the rates are today. That's what we're seeing on an average basis. Now, if you're buying, what we specialize in is we finance a lot of the really dilapidated stuff. So buildings that have really low rents, really
Mm-hmm.
rough condition are going to
Right.
go over a major overhaul.
Right. A value add strategy.
The value add strategy. So we'll
Yeah.
finance those at a higher loan to value because there's going to be significant capital injected behind us. So those are the type of strategies we more specialize in. But if you're buying the truth of the matter is, if you're buying an A rate type deal, an apartment building that's an A rate deal, you've probably not got a great price on it. It's probably been sold at a pretty fair market value. Most people who are going to sell a good building aren't going to give it away. Most of the people who are selling an apartment building at a discount are because it's in rough shape. So when you're buying something at market rate and you need traditional financing, it's a pretty large down payment. It's a 30-40% down payment that we're seeing a lot, which is causing those borrowers to say, hey, can I go with something a little bit more alternative to get into the deal so I don't have to put so much money down? It will impact my cash flow, but at least I have less money down up front.
Because they need to preserve cash for the reno.
That's right. That's right.
Yeah.
So even those good buildings that are in decent shape, there's still some units that they want to try to turn over. There's still some fix-ups that they want to do. So
Right. So then, in an alternative, I know it's a broad topic, but then an alternative mortgage, then an alternative lender situation, how much down does someone need then?
alternative. So it really is going to range. They're going to consider NOI, but it can be as little as 20. Depending on the private deal we're looking at, we fund private deals with as little as 15% down. That's got to be a big value add, though. We got to see a big lift on the property. But 25% in the alternative space. A lot of credit unions are still doing 25% down, 25-year AMs. So the good thing about the CMHC is the holy grail of this space. But the truth of the matter is, a lot of deals aren't actually going through with CMHC because it's not quite working out the way it needs to fit inside their box.
Right.
So credit unions are picking up a lot of that slack right now. They're doing a lot of 25-year AMs, 25% down, little bit higher rate, but get you into those common sense type deals that aren't great cash flow out of the gate, but it gets you into the property with a reasonable down payment, and you can start doing improvements to management, expense reduction, turning over units when possible, getting rid of delinquent tenants, etc.
Fascinating. And then much, I imagine, depends on the investor themselves, on your ability on their abilities, their resume, their background.
Yeah, and that's what I always call the investor profile. Who is this a high net worth person just looking to park cash? Or is this a couple who's really trying to expedite their growth, or a couple or an individual who's really trying to expedite their growth and grow fast and use real estate as a means for retirement? So that high net worth doctor, lawyer who's just parking cash, they might not care. They'll wait for the building to turn over. That other profile might be looking for a more aggressive strategy to turn things over.
Right. And I imagine you've met a lot of these hustlers. Sorry, I wrote down the word hustlers.
I appreciate somebody with hustle. I appreciate with somebody who's willing to put their nose to the grindstone and get a deal done. I'm blessed to work on both sides of it, where I have a lot of people who are willing to hustle and grow, and I have a lot of high net worth people who are just looking to park cash and deals. So it's really been a blessing for me in growing my business.
Right. And then Kyle, I want to talk about the private lending, your private lending business. Can you start with where you started in the private lending business and now where you are now? Because you've gone far.
Yeah. So I'd love to. So I got my start in. I'll tell you just a little background. Some people might know me, some people may not. It's 2023 today. I started investing in 2013, so 10 years ago now. I feel like when I say I've been in the business for a decade, it makes me feel old, but I've been in the business for a decade. I started with my first couple of deals with a pre-construction condo, single-family home, a triplex, and I came from the financial services space, so I was a financial advisor. So I was really into, the cost savings and the cost of the money. And for me, I started off with partners. So I would partner with people so we get a low-cost mortgage. And, In 2015, I went to a real estate education company. An HGTV star is coming to your town, going to teach you about real estate. So I went to one of those and I learned a ton. And I learned about the BRRRR and the flip to yourself strategies, where you buy, renovate, refinance, repeat. And I remember for the first 3 years after that, I would say all the time, I don't know why anyone would do private money. Just BRRRR it. Just BRRRR it. Just get your money back out. You don't need private money.
Stuff was a lot cheaper back then, though.
Stuff was a lot cheaper back then. Well, 2018 happened in a hurry, and that was when the stress test came down, the mortgage lending market tightened, and I still remember my first private deal, the first time I borrowed private money. My lovely wife and I, Chelsea, bought a property in 2017, right before the change, and she got the mortgage in her name, and we sold the property right into 2018, and we tried to port the mortgage, and we had a new deal closing in a month. And they said, no, sorry, miss, you don't qualify anymore. So we called around, and we ended up finding our first private loan for a deal that we were going to do, and we borrowed that money. Well,
out of necessity, you found a solution. Right?
Yeah. And that's when it kind of dawned on me, oh, maybe I can't BRRRR forever. Maybe I need to do something beyond the banks to accelerate. From there, I borrowed a little bit more private money myself to fund my own deals. And then about a year after that, a lawyer that I work with still to this day called me and said, hey, Kyle, I know you have access to a lot of investors and stuff. Start telling people that you have access to private money. I said, well, do I? And he goes, yeah, I have, myself and my clients have a lot of capital, and we would love to finance the type of deals that we've been financing for you. You're a broker. You're licensed to talk about this stuff. Let people know that you have access to private money. We're not guaranteeing anyone we're financing their deal, just that we have access to it. Well, I would say that phone call pretty well changed my life, because I didn't know any better, and I just started telling everybody. And what happens when you in this space start telling people that you have access to private money, your phone rings, and it rings a lot. And we've been blessed to be able to develop a relationship of a reputable private lender. We're not the cheapest game in town. We're not a discount private lender. But if I commit to a deal and say I can get it done, we get that deal done. So we've been a reliable source for a lot of investors to help grow and scale their portfolio. And as I mentioned, I'm not the cheapest game in town. I'm not a discount private lender. We are a premium cost private lender. But when you need a deal done and you need a reliable lender, you can count on, and we commit to your deal, we're going to get that deal done.
And the industry's changed a lot, because a friend of mine told me that privates now have to be brokered. Is that something that happened recently, last few years?
Yeah, so specifically with registered funds. So if you're going to deal with the registered accounts, you have to have a broker. And if you have more than 5 accounts, you need an administrator. So yeah, it's absolutely, it's really best to have a broker involved. And that's not a broker bias. I will tell you, I deal with some of, in the real estate investor scene, if you will, the community of a lot of people that we see on social media doing investing. I work with a lot of those people, and what a lot of them have discovered is our broker fee is 2%. We charge 2% to broker a deal, and what they realize is that
just clarify, that's of the lend amount. Of the lend amount. Not the total value of the property.
That's right. However,
that's my job as a realtor.
Yeah, exactly. We're like different 2% on a different amount. Exactly.
Yeah.
So what we found, and what a lot of these people found at first, they're like, well, it's, I could make that, I could save that money if I raise the money myself. But what they realized quickly is if they don't have to go through all of the administration, compliance, everything that we do to put the money together, they can focus on getting better deals. And if they could do 1 or 2 more deals a year that make an X number of profit, paying me the 2% to put the money together is a load off and actually more profitable for them. So as a newer investor, you have to learn how to raise money yourself. You have to be able to do it. But when you get to that pendulum of scale, it almost becomes less expensive to have a broker handle that side of for you, and you just negotiate better deals. When you're at the finish line of a deal negotiation, you're like, I got to get this 2% less because I got to cover paying Kyle on this deal. So that's how a lot of them look at it.
I think many people don't understand like how much stuff costs. Like for example, everything you need to do for your regulatory requirements.
Yes,
We'll
absolutely.
get to the fund in a bit. And you can tell me how much that costs you.
Oh, it's a lot.
So this is awesome. And so sorry, and you mentioned that you were working with a lawyer who had a ton of money. Has the journey changed? Are you still is that still the primary source of your capital of your private
Yeah, no,
money
that was
lend?
my. I like to call that my confident. It was my confidence money. So I
Right.
wasn't
Okay.
out there just I wasn't full of it, right? I was telling the truth. I did have access to private money. So it's certainly a partner of mine and somebody that I still work a lot with to this day. But that also gave me the confidence to start talking to other private lenders and start telling them that not only do I have other people who come to me to lend their money, but I now have borrowers coming to me because it got to the point where when I started telling everybody that that first lawyer couldn't do all the deals anymore. So
Mm-hmm.
I still that I call that my confidence conversation. That's where I could put myself out there as a private lending broker. And not only did that attract a ton of borrowers, it gave me the confidence to talk to other private lenders and say, hey, I can help you.
Right. 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 And it's you've raised a lot of money. You mentioned 150 assets under management, 150 million. Yeah. Apparently, there's a lot of money out there. Is that your
There,
experience?
yeah, there is. And you and I talked about this previously. And one of the things that I'm really passionate about, or it's part of my core beliefs. There's a lot of money out there, but there's a lot of people that don't respect the money, and they treat OPM like a gimmick.
Other people's money. Yeah.
Oh
OPM.
yeah, OPM, other people's money. Like, oh, I'm gonna get OPM. I'm gonna get OPM. They do big blurbs and videos. OPM, OPM.
Mm-hmm.
I don't talk to people. I don't talk to people about their OPM. I talk to people about their retirement account, about their children's education fund, about their lifelong savings, about the equity that they've scraped together in their home. And when you start treating people like a gimmick OPM, you're going to struggle to raise money.
Mm-hmm.
But when you start treating people and their money and their hard-earned savings with the respect it deserves, and bringing them secured lending opportunities where
Mm-hmm.
they're even an owner in the property or they have a registered mortgage position on title, you're going to find that the access to money expands very, very quickly, including referrals. People start telling, "Hey, I'm working with this guy. You lend your money. It's a registered mortgage position. You know, it's not. This isn't some fly by night operation. You're lending your money as a secured mortgage. Oh, really? What do you get a double digit return? Wow, tell me more." And they tell their friends, and they tell their friends, and high net worth people hang out with high net worth people, and in the high net worth communities, talking about money is not a faux pas.
Mm-hmm.
It's not bragging or boasting. It's sharing and growing
Mm-hmm.
together. So
Mm-hmm.
when you become a trusted source within those communities, your name travels fast.
So, Kyle, I'm actually curious. Who are your lenders? Are they high net worth individuals that are lending cash, or are you even talking about like mom and pop who are lending like HELOC money?
Yeah, little bit of everything. A little bit of everything. So certainly high net worth people with registered accounts. So RSP money, TFSA money. Definitely high net worth people into retirement. They paid off their house. They opened up a HELOC, and they used that equity in their home to help service their retirement. Uh, this isn't a secret anymore. I give it on pretty much anytime somebody asks me about this. But I've got a great deal of capital from uh, entrepreneurs who have holding companies and operating companies sitting on retained earnings. So maybe they own a manufacturing company, maybe they own a windows and door company. They were a contractor, they were a plumber, a mechanic, and they
Right.
ran a business for years and retained a lot of money in their
Mm-hmm.
corporations.
Mm-hmm.
They don't know what to do with it.
Okay.
They don't know what they can spend it on.
I
But
feel
a lot
sad
of
for
these
them.
people aren't real estate investors. but they aren't real estate investors, but they have invested in real estate. They had a shop that they own in some core area that's worth $1 million now, and they paid $100,000 for it 20 years ago. They got a house in the burbs that they paid $200,000 for that's worth 1.2 million.
Mm-hmm.
So they aren't trained real estate investors, but they understand that real estate is a good investment. They made their money somewhere else. They don't want to become a landlord, and they're sitting on these retained earnings. And that's been a great source of capital for me, from those type of people who understand that real estate's a good investment. Their time is spent on their business, which is manufacturing a plastic part, but they want to get it. They want to put it into real estate without spending time or energy, and private lending is a great spot for them for that.
Right. They want to earn that cash flow without putting the effort.
That's right.
So Kyle, before we were recording, and so we're just going to talk in general terms. We've both done really well in real estate. A lot of people have done really well in real estate. Some people got it wrong, lost their shirts, lost the other people's money as well. So they lost other people's shirts. Where is private lending now? And for example, before we were recording, what I wanted to, I was going to ask. I said I was going to ask your opinion on promissory notes.
Yeah.
Right.
So promissory note is a swear word to me. And here's what I'm going to say about that. In terms of any type of scale business operations, promissory notes should not be part of that. Okay, so if you're trying to be a serious real estate investor and raise serious capital and become an authority in the industry and somebody that people can count on for as a place to invest in, and you're doing promissory notes, I think there is a shelf life on your business. Now, what I will say is there can be a time and a place. If you have somebody you very much trust and you have a long-standing relationship with, and there's a small amount of money that you're going to do for a very short term, 30, 60 days, clear exit strategy, and you really want to do, and you're okay with doing that, I still would not condone that and think that's a good investment, but that's your call. But if you're an investor now, especially in today's market, there was a time there a couple of years ago where the borrowers were almost calling the shots. Like there was almost more money than borrowers. So the borrowers were like, I don't want to pay the legal fees to secure it. So the investor's like, oh, I want the return. Okay, I'll do a promissory note. And it's just crazy to me that people would spend more time researching their vacation than researching the security where they're going to put hundreds of thousands of dollars. So the answer is promissory notes. Don't do them. It's not a good investment for you. Borrowers, you're long-term devaluing your brand. Lenders, you're writing your money on a napkin. Don't do it. So secure your money. Get a registered mortgage position. The way the market has changed recently, there's a lot of demand for capital right now. Banks have tightened up. MICs have tightened up. The lenders have tightened up. As a ma and pa lender, demand it. Demand it. Why not secure your money? Why not pay the lawyer to secure my money? Is my money not
much
worth
money?
It's not that much money.
Much.
It doesn't cost. And it's funny because I have people. Some people will say to me, "Hey, I saw that deal you just posted, Kyle. That's a second mortgage. I don't know if I'm comfortable with that." And I would say, didn't you tell me you have $200,000 on a promissory note to somebody else? But I trust them. Okay, well, whether you trust them or not, register a second position. Charge it. Charge the property.
Yeah.
And I'm going to speak broadly about this, and this isn't so specific about anything, but in the event of a catastrophic failure of a company or business, the secured lenders get paid first. The secured lenders can be released from the proceedings and have the assets take for them to deal with. The unsecured lenders sit and wait for lawyers, professional fees, trustees, etc. All of these things, all of their fees come before your principal. And this is so important when everything's rosy and happy and everything's going well, nobody thinks anything about a promissory note. But when crap hits the proverbial fan, the unsecured lenders are lucky to get pennies on the dollar. And that's not an exaggeration or a quote. Pennies on the dollar. So secured lenders, however, if you're a first position mortgage, what does that mean? You get paid first. You get paid first. If you're a second position lender, after the first position lender, you get paid. And you're charged in that order. So you don't have to wait for things to go through a big process. When the property is discharged, who's in first? They get paid first. Is there money left over? You get paid second. So from a risk perspective, you want to be in first whenever possible. But if you have somebody you trust and you want to do a loan to them, say, hey, I'm just going to tag your property with a second mortgage, just so I'm in line, just so there's no question about where I am in line. If they say, oh, well, can't we just do it as an unsecured? No, why?
Yeah, that's a red flag.
That is a red flag. Why? Is it not important to you that my money is secured?
Yeah.
And like I said, 2 years ago, the market was at a weird spot where borrowers were calling the shots. If you're a mom and pop lender right now and you got some money to put into the market, this is my favorite line, and I've used this for years. It's called the golden rule of lending. And the golden rule of lending is he or she who has the gold makes the rules. They who have the gold make the rules. So if you're lending your money and somebody says, I don't want to do a promissory, I want to do a promissory note, I don't want to pay the legal fees. Thanks. Have a great day. No, thank
Especially
you.
in this market.
Secure your money. Get a registered position on property.
Right. I just want to remind the listener, we had a lawyer on just like a month or two ago who's working on 32. He's a sole lawyer practice, and he's working on 32 power of sales himself. Right? So yeah. Like you can't tell me shit doesn't hit the fan.
It does. It absolutely does. And the people who are secured, when shit hits the fan, the people who are secured, I'm not saying you're not going to have any stress in the scenario, but you're going to be able to sleep at night. Mm-hmm. Your money is registered against something. There's bricks and mortar tied to your money.
Right. The reason why we invest in real estate.
That's why you invest in real estate. Right? So if you're unsecured, you're not tied to anything, and I can assure you are going to lose sleep at night.
That's funny. Like the promissory note's almost an analogy for fiat currency. Would you rather have something hard, or would you rather have something not secured by anything?
Yeah, I mean, I hear the odds are pretty good on black and roulette. You know, that's what, and you laugh, and everyone laughs when I say that, but that's honestly what I believe when you're doing a promissory note. You go to the casino, put it on black.
I don't gamble. I don't gamble.
Yeah, me neither. I say all the time, I'm too financially literate to gamble. I can't. The odds don't make sense. I can't.
The odds don't make sense. So Kyle, your name kept on coming up. So you can respond however you want, but your name kept coming up in the kind of like thank you, Kyle. People are saying like thank God Kyle, like shit hit the fan. Thank God Kyle was there to back it up. Can you elaborate on any specific or general stories you want to share?
Okay, so
because shit does hit the fan, right?
Yeah.
And then
so
what?
in 2022, we were blessed to never have a default. Okay. In 2022, we had two different companies that went under. It totaled 5 properties, so 3 with one company and 3 with the other. I'm not going to get into any names or specifics or numbers or anything, but in my overall practice, we had 5 properties go into default over 2 companies. One of the value adds that I've always told my lenders is I'm an investor first, and if shit hits the fan, I will do whatever I can to help. And in these scenarios, the underlying companies that own the properties that we lent money to went under, but the assets and the deals we lent on were actually okay. Like they were still decent deals. So the decision that I made along with my team, the 2 agents on my team helped contribute some capital to me to help me get to recover these assets. We made the decision to buy all 5 properties from the power of sale process. We backpaid our lenders the interest that they were owed for the months of the power of sale period. so there was no loss, and they were out of the bankruptcy proceedings. And we have, out of those 5 properties, it's now, this all happened in approximately September. We're now in April now. One of them is already sold, one of them is listed, and the other 3 are all being listed in the next 2 to 6 weeks. There's some weather issues that we've been waiting on for the exterior work to finish. In all 5 of those deals, all of my lenders will be receiving 100% of their capital back, all interest. The only thing that they've had to do is they had to stay in the deals a little bit longer than they wanted to, so I could get the construction done. But we were able to recover all the assets, and I'm not going to make any money on buying these properties. I should about break even. There's 2 that I'm going to lose a little bit on, 2 that I'm going to break even on, and 1 that I should actually make a few bucks on to cover my other losses. So I hope to break even on the whole thing. And we made the decision as a team that we wanted. If we were going to take a loss by doing it, we wouldn't have been able to do it. But we made the decision if we could at least break even to protect our lenders, I was willing to put the time and energy into doing that. And I'll say this as a final thought on that. In no way is this a guarantee that I can do this every single time. But if I can, and if it makes financial sense for me to go in and step in and recover the asset, I'm more than willing to do that. Once again, we earn a good income for what we do. And I want to make sure that I step up and take care of my people when a problem happens. So
that's pretty impressive. Your own staff put in their own money too.
So yes, they did. So they lent the money to me. So to take secured on the properties, just so that's said. They put some money in as well. They were agents on my team. They had their clients in. They wanted to make sure that they, we wanted to step up. Like I said, the companies that we lent to failed, but the specific assets that we were secured to were still decent deals. Mm-hmm. There was still some. They weren't. The companies went under for other factors. The specific deals that we were on weren't the problem. Mm-hmm. So we made the decision because of the properties and their condition at the time. Had we sold them, the lenders would have taken a hit. So for me to spend 6 months managing some construction projects is not. It's been a lot of work. I shouldn't sugarcoat it. It's been a lot of work, but worth it. I said this earlier in the podcast. I didn't know if you were going to specifically bring this up, but this isn't OPM to me. This is people's retirement. This is people's children's education funds. This is their home equity. And if something happens, it's not like, hey, sorry, new OPM, I'm going to go get new money. It's we got to do whatever we can to help these people. So,
mm-hmm. And to the novice investor, I think they should always, whenever judge an investment or investor they're partnering with, just simply ask yourself the question: will they shed a tear if I lose my money? If the answer is no, run.
Run. I have some things that some of the criteria that I look at when I'm underwriting deals is I want to know what if the deal goes bad, what will the operator do? Will they go get a job at McDonald's to help make this right? And by and large, I'm right. When I underwrite a deal in 2022, I missed on 2, but in the grand scheme of my portfolio, that's mm-hmm. quite a small percentage. Mm-hmm. One other little tip I'll give people when it comes to lending money and partnering with people. I don't do this as much just for loans anymore, but I certainly do this with partners. If I'm going to partner with somebody, if we're going to be a partner in a business, we're going to go out for dinner and we're talking about religion and politics. And I hope we don't agree. But can we have a cordial conversation? Can we agree to disagree? Mm-hmm. Because if you're going to get into a partnership with somebody for 5 or 10 years, you better be prepared to have difficult conversations.
Yeah.
Right?
It's like a marriage.
It is a marriage.
Yeah.
There's benefits to a marriage that you don't get in
Yeah.
a real estate deal as well. So you
Yeah.
better be able to have those tough conversations.
Yeah. You're
So,
getting married. You better talk politics and religion before you tie the knot.
yeah, yeah, and like I said, some people are like, "Oh, well, what if we don't agree on it?" Well, I hope we don't agree. I hope we have a difference in opinion.
Yeah, let's figure that out now
Yeah,
before
but
later, before we have babies together.
that's right. And if there is a difference that we can't overcome it, great. Thank goodness we had this conversation.
Yeah.
And if you're blue and I'm red, or I'm red, you're blue, or whatever that is,
Yeah.
and we say, hey, that's an interesting point. I've never heard somebody bring up that side.
Yeah.
I'm going to think about that more.
Yeah.
I'm not going to change my vote, but I hear you and thank you. And vice versa. Hey, I hear your side as well. That's interesting.
Okay.
Maybe we're not going to vote for the same team, but at least we've had a difficult conversation and we've come to a reasonable understanding together.
Mm-hmm. So just to add to that, you're already going into a real estate relationship. So I'll just throw in, if you're going to go into a personal relationship, you should bring up real estate as well. I'm a real estate investor. I want to buy more real estate. Are you down with that? Like, you know what I mean? I'm anti-debt. And then like you're going to have challenges.
It's not going to... I have a couple of things I want to say about that. Recently, a friend of mine posted on social media saying, "What do I do if my spouse isn't on board with real estate?" Yeah. And I responded with divorce him, because I've been in this business for a decade, and I've seen many people that I had a call with 5 years ago call me back just recently saying, "I finally got rid of my spouse. I'm ready to buy real estate." And it sounds like a joke, but that became an issue for them. One person had this goal and this ambition, and the other one didn't. Yeah. The other thing I'll say is, there can be boundaries that you put in. If one person doesn't want to sign debt, whatever. But
yeah, I have those clients too.
Yeah, as long it's a difference between not interested and not supportive.
Mm-hmm.
Right? If they're just not interested, they don't want to sign on all these mortgages, they don't want to do the calls on evening and weekends, but honey, do whatever you want. Whatever you want to do, whatever you want to sign for, I support you. Yeah, I hear that. Don't touch our house. Don't touch the house. Do whatever else you want. So,
yeah. All right, Kyle, let's talk about that fund.
Yeah.
What are you thinking?
Well, I'm thinking my lawyers and accountants did well so far. We're well,
and they probably slept well at night too.
Yes, they did.
And sheets.
Yeah, we're well into six figures in starting the fund and accounting and legal fees. It's not for the faint of heart, guys. You're going to pay accountants and lawyers a lot of money and still be shocked at the amount of stuff they're asking you.
Yeah, and ongoing fees. For like ongoing perpetuity. Fees. Yeah. As long as the fund exists, there's going to be ongoing fees.
That's right. And what I was shocked about, and I just want to say, because if they hear this, the team of people we hired were fantastic. They were amazing. I couldn't have done it without them. But I was shocked at the amount of stuff that they still had to ask me. I get another bill for X amount of money, and I was like, but I still have to answer all this. So just be aware, if you're going to do it, that don't if you're a newbie, don't start a fund day one. You need to have some background and some stability underneath you before you start spending this level of capital on a fund. But I am a firm believer that the fund models are the future of investing in real estate. I think the classic JV splits, you go on title, you do the work. I think there's a shelf life on that type of stuff. I think it needs to be done in the fund model in the future. For private lending, it makes life so much easier for not only the lenders, it's much more passive for them, but also for the borrowers. When you're dealing with an individual private lender and something comes up on a deal, so you're going to be 90 days delayed. Well, that private lender, even though they're not supposed to commit to anything until they get their money back, buys a cottage, and they need their money back instantly. The term's up, the borrower needed a 60-day extension, the lender needs their money. It just creates a lot of stress. So having the fund model eliminates a lot of that emotional in that. The fund can extend. The fund can do more things without that individual emotion in the deal. So
because life happens too.
Life happens, 100%.
Yeah, things happen, like, car accident, injury, the big C, like
Yeah,
things happen. Yeah.
yeah, 100%.
How does that change for the lender, like, or the borrower? Let's pick one place to start.
Okay, so for the lender, the benefit to the lender in investing in a fund is, first of all, there's no more downtime between deals. So you don't do a deal, get your money back, wait for a new deal, do a deal, get your money back. So it's invested in a pool of mortgages, so it's always out to work. It's also more passive. In the current model, you have to look at a deal, ask your questions about the deal. I like the deal. I sign the paperwork for the deal. I go to the bank. I get the money for the deal. I go to the lawyers. I sign for the deal. I wait for the deal to pay back. And then I get my money back.
Mm-hmm.
In the new model, you do your due diligence up front. You ask your questions up front. You deal with our EMD. You go through our declaration of trust and our OM all up front.
Right.
Once that's done, you put your money in the fund, set it and forget it.
Right. So this is regulated under Ontario Securities Commission.
Yeah.
Which
So
will
it's
cost you as well.
Yes. So and then you get a monthly distribution. So set it and forget it. If you're lending with registered accounts, it's substantially less capital. It's substantially less fees to be doing a fund or a share purchase of a fund than doing self-directed mortgages. It goes from about $500 a year to $75 one time. So it's much less expensive to do the fund model. The other big benefit that this is going to have for people is we can drip the returns now. So if you're getting a monthly distribution, you don't need that for lifestyle. You can reinvest and compound it. We have many clients who are sitting on a bunch of cash in registered accounts because they get their monthly payments. They can't, it's too small to reinvest. So they have to wait for it to reinvest. The other side of it too, and not that we're still not attracting very high net worth people, is the minimums are much less. So $10,000 is the minimum. We have an introductory rate of $3,000 where people can get in a little bit less right now, but the standard minimum is $10,000. In the current private lending space, you really have to have like 50 to get in, but more realistically, it's 100 to get in. So much lower barrier to entry in the fund model.
Yeah, because I've heard even some lenders won't talk to you unless you have like 250. All right.
Yeah.
And my number seems to keep going up.
and Erwin,
depends on the market, I guess. Yeah.
It's the market. It's the real estate values. If you have a $500,000 deal and you got 10 people putting in $50K a piece, have you ever tried to herd cats? I would say it's easier than dealing with 10 lenders on a deal.
Yeah. I think you should do an open house with novices and have them come into your offices and see how much effort it is to do a raise.
Great idea.
Because I don't think people appreciate how much admin work goes into what you're doing, into brokering a deal. Because you have one side, you have the borrower, and the other side, you have the lender. And then, like you said, like there's all these personal things that always come to play. I'm at the cottage, I can't review documents until Monday. Or I'm going on vacation. Can this wait till Friday? Borrower needs the money in 48 hours. Right? But now you're saying it's all gonna be consolidated. So I have a quick question about the fund then. What kind of transparency do people have in terms of like what they see go into what deals, in terms of like, do they see anything about what kind of deal goes into the fund?
So they are not lending on specific deals anymore. So we have a trustee model. So there's 4 trustees in total that oversee the loans and the management of the money. We are bound by our OM to only do secured lending. So whenever we lend money, there's a registered mortgage position on the property. Mm-hmm. So no napkins, no IOUs, handshakes, P notes, anything like that. Mm-hmm. Registered mortgage position. Mm-hmm. We are bound by certain loan to values depending on the tier of the share class that you invest in. But in terms of the specific deals, there is no say in terms of the lender perspective or the investor perspective. Mm-hmm. It's a language I have to change now. Right now I deal with lenders. In the fund, I deal with investors. Mm-hmm. So it's a little, there's no say in what projects we're investing in or lending on. Now, with that being said, we are committed to a quarterly update. We're probably going to do monthly, but we're committing to a quarterly update of just what deals we're currently in, how those deals are going. More of a newsletter type model than a individual individual property things. So,
Right.
and this is different strokes for different folks. We have some people who very much like knowing I'm lent on 123 Main Street. I'm in first position. I know what it's worth. I drive by it every third Tuesday of the month.
Mm-hmm.
That's okay. But we have many people who also, more information isn't necessarily a good thing for them. They get nervous when they get updates. They really do want something more passive, and where it's spread across a bunch of things. If there's one problem at one property, they don't know, they don't care, they're not worried about it. So it's different investment. It can be a little bit different investor profile potentially.
Mm-hmm. Mm-hmm. But so what's going to go into the fund in terms of deals that you're going to fund?
Yeah, so we are a income fund, a mortgage trust. So I'll give you a little rundown on this. So a REIT, many people are familiar with a REIT. A REIT is a real estate investment trust. So it's basically a fund that buys real estate. The underlying legal structure of a REIT is an MFT, a mutual fund trust. That's the legal structure they use underneath it, but it's known as a REIT. It buys real estate. A MIC is a mortgage investment corporation. So that's what we started to build. That's what we were going to do, build a MIC, which, like a REIT, is a pool of investments, but instead of buying properties, you lend on mortgages. So the challenge with a MIC, though, is you can't exceed 50% residential mortgages, which means an apartment building, a 10-plex, counts as a commercial mortgage. So we didn't like that restriction. We love apartment buildings. We love lending on apartment buildings.
Yeah.
So what we did is we created it's almost a new class. There's only a handful of other people in the country who are doing this, but it's a mutual fund trust structure, but it's designed to only lend on mortgages. So it's designed to just lend on secured mortgages. Now, the cool thing about our structure is in the event of either an individual disaster or a large-scale disaster, like an economic downturn, our mortgage trust, because of the underlying structure that it's built on, can own real estate. So if we need to, if a deal goes sideways and we need to recover that asset and take it over, our structure allows us to do that. So we put a ton of thought, energy, and accounting and legal fees into building this structure that we believe is not only amazing for our investors in terms of lending and investing their money, but it allows us to protect the principal in the event of a disaster.
So you can take possession of the property and kind of like you've done in the past is take possession, renovate it, whatever you need to do, get it ready for sale, maximize your exit price.
Exactly.
Would you even do I know someone who did a sever and build on one. They had to take back a property, and it was like 50-foot lot. It actually made sense for them to tear down the house and build two semis.
Yeah.
Is that something you would do too?
So
complicated question.
Yeah, I would say no. Then this is what people have asked me many times. So our targeted returns within the fund are 8, 11, and 14. So disclaimer, you have to go through the EMD. It's got to be suitable, all of those things. But our targeted returns within the three funds are 8, 11, and 14.
Right. Seek professional advice.
Seek independent legal advice, accounting advice, absolutely.
Yeah.
But people keep asking, well, are you going to be able to, should we expect more? Like, are you going to exceed these returns? Are you? And the answer is, we're not planning on it. We're planning on consistently delivering them and being a stable income fund.
Right.
We're not an equity fund. We're not going to do a deal that's going to hit it out of the park and hit a way bigger return.
Right. That's not
we lend just above the rates that we've quoted you at to deliver those returns consistently, and we have a great stable of borrowers ready to do that. So to answer your question about would I sever and split and all those things, the answer is if we take over an asset within, our plan is not to maximize the investment deal. It's just to protect principal and get the money out.
Mm-hmm.
Now, if there's ever an opportunity that comes into the fund that goes into recovery, my answer is I would probably buy it outside of the fund make sure the principal within the fund is protected, the income is stabilized, and if an opportunity came, I would look at purchasing it outside of the fund because this is an income fund. This is about mortgages. Our underlying structure to own property is only to protect. It's not a way to generate higher returns within the fund.
I've spoken to some private lenders who had deals go bad. I'd imagine someone would sleep better at night if they were in a fund that's regulated under Ontario Security Commission versus having to go through the process of power of sale or whatever, or you taking control.
Yes, it is, and I mentioned this earlier. There's many people who go through suitability and go through all of these things, and they come out as a very aggressive, advanced investor, and that has a high risk tolerance. But when a deal goes bad, no matter how much you say you were comfortable with it, when it's actually happening, people get nervous, they get scared. It's a lot, and all of the little updates can actually create some more stress for people. And in the fund model, they don't see that stuff. As long as they're getting their return, even if there's challenges going on specific loans within the fund, as long as we're still able to maintain the yield, they don't have to hear about all the gritty little challenges that are causing the fund manager stress, as long as the yield's being delivered.
So Kyle, we always like to talk about what's the worst case in the truth about real estate investing. We talked about earlier about what if someone just did it individually, like one-to-one, lender borrower. How bad can it get? So, for example, a friend of mine lent a second mortgage on a house. She wanted to be passive, but of course, the borrower did not let the lender know that she was behind mortgage payments. And my friend did not find out until the bank had already started proceedings to take back the property. So I believe the immediate cost to the homeowner and borrower was over $10,000 just in legal fees that someone has to pay. Can you speak from your experience? Like, what is it like if you're on your own type thing?
Yeah. So what was the first question you asked in that? What is the
if someone's trying to do a private lend deal on their own, and then the deal goes sour? What's
the worst case?
Because in my experience, went just like no different with tenants. If they're going to miss rent, they usually don't tell you. No different with the borrower. If they're going to miss a payment, they usually don't tell you.
Yeah. So
you're already in trouble at that point then.
Yeah. As a second position lender, you are at risk of being fully wiped out and not getting any of your capital back. Okay. So that is a genuine risk that you have in second position.
Right. Especially if you're not on top of it.
If you're not on top of it, right?
Yeah.
So that's an interesting thing about deferred interest as well. If you have a deferred interest deal, you might not know that something's going wrong because you're not getting paid until the end.
So you have even less chance of getting a red flag.
Yeah. So in first position, it is very unlikely that you are going to take a major loss. Is it possible that you take a 10-20% hit on principal in first position? It is possible. It's possible to take more, but depending on your underwriting guidelines and what you've done, it's possible that you take a 10-20% hit at first position. It is very unlikely that you lose a large portion of your principal lending in first position. The point you brought up about lending in second position is absolutely true. You need to know who you're behind, because there's a lot of mix that won't say anything to you. If they're in first position and you're in second, if that's me, I just have a moral compass. If I'm in first position on a deal and we're going into power of sale or default, and I see that there's a second position there, we're going to do some work to find out who that person is and let them know what's going on. Whether I don't have any obligation to that, but I'm going to do it because I want them to know we're taking action. So if you're in second position, make sure you know who's in first. If it's some Joe Schmo private and you don't know them, you might want to do some due diligence on that. If it's a bank, most banks are going to be pretty quick on it and will serve notice to all chargees. So if you're charged in second position, they'll serve notice. But yeah, If you're in first position, there's a chance you're not going to get your interest. There's a chance you could take a small hit on principal. If you're going to take a big hit on principal, either the market's completely crashed or you've done something terribly wrong in your due diligence. There's a good chance you shouldn't take a big hit on principal. If you're in second position, if you do your due diligence, you also shouldn't take a big hit on principal, but it is possible. There is a chance, though, that you could be fully wiped out. There was a deal that one of the properties that I mentioned earlier, somebody was behind us. We tried to work with them. We offered to let them buy it off us. They didn't want to. They said they would take their chances, I guess. And they were fully wiped out. There was nothing we could do. We were in first position. My duty was to my first position lenders. My moral compass tried to help the second person too. They took their chances and they were wiped to zero.
So in the story of my friend, like she was looking for a passive investment, and then she had to buy the property. So automatically went from not passive at all, having to pay the legal fee, having to discharge the first, taking over the property needed work. So people need to understand that, like, the worst case, it does happen, and then you gotta have the ability to close on the property if you have to,
or lose all your money,
or lose all your money.
So good for her for stepping up and taking it over. But
not everyone's capable of that. She's a high net worth individual,
right? And this is another example of I have heavily tightened up my lending area because of what happened. So we were lending all over Ontario. We've now tightened it up to within 3 to 4 hours of the GTA. Because if I got to recover this asset, I don't need to go there every day, but I need to be able to go there. So if you're going to lend money to people, and you are that high net worth person looking for passive investment, just in the back of your mind, where is the property? Because if you need to protect your money and get involved more, you might need to go to it. So a lot of the gurus teach about invest where the return is best, which I am a believer of that. Invest where you get a great return, but invest close to home when possible. And understand the risk you're taking by investing farther from home. So.
I was speaking to a bankrupt investor who lived in London, had properties in Muskoka and Hamilton. Like, good Lord, that would take you a long time to cover that kind of territory. So Kyle, again, just to go back to that, you are a mortgage professional.
Absolutely.
Can you give us a bit of what your take is on the current market? Are you seeing more buyers coming out, or are the things dead out there? What's going on?
Yeah, so we're end of April 2023 right now. I love your opinion on this too, while we're chatting. But I have seen a big uptick in consumer confidence here in southwestern Ontario. It looks like we're getting a little bit of stability in the rates. The bond market has settled down. The BOC has settled down and looks to be relatively at bay. When things were going up so quickly, what I noticed with a lot of people is it's not that they couldn't make their payments. They were okay. They were just holding back because they didn't know how high it was going to go. Right? And now that's kind of settled in, a lot of people are like, okay, yeah, we're good now. We can make this payment, or we locked in at a fixed for 2 years. So we're going to, excuse me. We locked it at a fixed for 2 years. So we're good now. Or we went to our boss and asked for a raise. So we're good now, whatever that may be. So I'm definitely seeing the consumer confidence uptick coming back. I'm seeing the pro investors that I deal with didn't stop. They were buying the entire time. I'll call them semi-pro. So the 3 to 5 property owners, they definitely are inching back into the market looking for deals. But right now, the duplex, triplex, fourplex game is pretty tough to get cash flow. So I still think it's a great start for a lot of people, but you're not going to be getting big time cash flow coming from those. So you got to know your numbers. I think for people getting started in the business, they need to understand construction and value add. They need to understand how to appreciate properties, because that's the major play. And I'm predicting a bit of a, my crystal ball has never been that great, but I'm predicting a relatively flat market for a while. I'm not expecting major appreciation. I'm not expecting a major decline. Um, we have major immigration coming into Canada. For anyone who's opposed to that, you're wrong. We need it. Our labor force needs the immigration. We need people here to helping us grow our labor force, but we don't have housing for them. So that is a problem, and that's something that needs to be addressed, which is going to create buoyancy in our market. So that's my opinion on where I see things are going and what we need. So I'd love to hear what you're seeing too, Erwin.
So what I'm seeing on the street is recovery is coming faster than I expected.
Yep.
A house very close to me sold not far from its peak price in one day. So I think because there's the baseline would be like what the peak was. So then there's buyers out there who are capable of going somewhere between what I think is fair market and what was peak, because there's a lot of people that believe that we'll be back there within a few years. So, and we're losing to lots of people who are buying for themselves. And those people are generally willing to punch harder than we are for pricing.
Yep.
And it's a broad spectrum in terms of like turnkey, and even disaster properties are having multiple offers. But we operate most in the starter category. The luxury market I've heard some people say the luxury market never really slowed down because a lot of those are cash buyers, so they don't care about interest rates. But yeah, we'll see where things go. I feel like for my own pricing, I'm thinking like 1 to 5% appreciation from here, not major, something along the lines of inflation, right? Because I'm not sure what you're seeing in terms of construction costs, but my contractors are not quoting any cheaper.
No. I'm right there with you. I've been a 3% guy on my performers forever. My performers have always been at 3%. Because I thought that was a relatively inflation type number. So even when things were 20% on my performance, I was still 3. Because I knew at some point, if it was 20, it was going to have to be minus 10 at some point. Right? So I think that's, and in terms of the construction costs, it has not gone down. I met with a couple of my contractors recently who give me good pricing. And they say that, they were reviewing things with their accountant and really getting to the bottom line of things, and they have to charge more.
Yeah.
Like they're all their soft costs, their WSIB, their car insurance, their tools, the equipment. What's that?
Everyone's like you mentioned, like people are asking for raises. All the labor's asking for raises.
They want benefits, they want RSP matching, they want all of these things, right?
Benefit and pension, like the government gets, even though they're striking.
Is it not? Let's not get into the irony of CRA striking at tax season.
Yo, Kyle, I had a fun use this fact of the day. The government's union instructed their remote workers to leave home and go to join the picket line. I thought that was hilarious. You may not virtually protest. You must go protest in person.
Wow.
What a world,
that's
wild. Kyle, thanks so much. This has been a blast. Any final thoughts? Where can people follow along? Where can people learn more about your mortgage fund? Where can people follow you and your journey?
Yeah, capgapmft.com, info@capgapmft.com for anything on the fund if you're looking to get invested. Info at Kyle Ford Mortgages if you're looking for great mortgage brokers. Full transparency with a lot of the viewers. A lot of the mortgage brokering, I have my team handling that now. I got incredible agents that will be available for you.
Big fan of Anna Scott.
Anna Scott, Steve Aho, Chris Landoni, Terry Legault. We have great people on the team that can help on the mortgage side of things. CapGap MFT for investing in the fund, and Kyle Ford Invest on Instagram. I don't really try to grow that, but I should. So I want to share more content there. So yeah, Google me. I try to share my wealth whenever I can, share my information whenever I can. So
I like the idea that you're sharing your wealth, but okay.
share my information.
Cal, again, thanks so much for doing this. I had a blast. Hope you had fun.
Yeah. Thanks for having me, Aaron.
Thank you for watching. If If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy that I personally use in a virtual free training class every month. Go to investortraining.ca/YouTube to register for our next class. The link is also in the description as well. I publish at least 2 to 3 videos a week here, so subscribe if you want to keep learning from seasoned investors like myself and my guests. And if you're just starting out, feel free to ask questions and comment below, and I do the best to answer each of those comments and questions myself. Again, if you're ready to learn the nitty-gritty about real estate investing from a professional investor, register for our next virtual class. That's at investortraining.ca/YouTube. Thanks again for watching. See you in the next video.